Good afternoon, everyone, or maybe good morning, depending on where you're listening to this update from. I appreciate you joining me for today's economic update. I did an update in January, and clearly the world has changed over just the last couple of months. I appreciate you taking the time. We are going to cover a number of things that I think are important, but to begin with, I don't know if you feel like I do sometimes, but this funny GIF was sent to me by my wife, Joelle. This is Chris Farley. One of my favorite movies is Tommy Boy. I know it's not the most sophisticated humor in the world, but I do love that movie, and I feel this way a good bit of time, getting pretty tired of living through historical events. I've said this to a lot of people. I can't believe that I'm talking about a war in Europe, certainly historical events, and this comes on the heels of living through a pandemic and an economic shutdown, crazy stuff. And hopefully this makes you laugh a little bit or smile a little bit. It did for me. So the agenda today is pretty straightforward. I wanted to talk a little bit about the tough start to the year. I want to cover some historical notes about the markets. I want to cover the inflation story in some depth. Then I want to cover some causes for optimism, talk a little bit about diversification. We're going to touch on interest rates as well along the way. And then some key takeaways before we finish up. We will, I'd hope to do this in less than 40 minutes to accommodate everyone's time, be respectful. If you want to pose a question, please do so in the chat. If time allows, I'd love to get to it during the presentation, but even if I don't, I'll get back to you after by phone or by email and answer questions you might have. Again, I want to be respectful of everyone's time, but please throw some questions directed to me in the chat button. We've had a tough start to the year. The cause of this are several. But a few things I wanted to focus on, main ones in my mind, I want to share with you and give you some thoughts. To begin with, supply chain issues persist. And this issue, like a lot of what we'll talk about today, you see in your everyday life. You see it when you're buying stuff because you might not be able to get it. You might have to wait a while. It's a really unusual turn of events in this country. I've never seen anything like it, where there are shortages in so many different areas when you're trying to buy goods. It's really incredible. So this has lasted a while. I think it will continue to last for some time. There are a lot of things that are contributing to this issue. The economy will work through them, but it is going to take some time. And this supply chain issue is also related to the labor market, which has its own challenges, but it is a component of the intensification of inflation. We have red-hot inflation right now. We started talking about inflation almost a year ago here at Elliott Wealth Management, and it has certainly gotten red hot over the last couple of months. I think it's also captured the attention of Americans. This is not an economic topic that is difficult to understand. People see it. They feel it. They're observing it in their everyday lives as they go out to restaurants, as they travel, buy food, pay their energy bill, pay workers when something needs to be fixed at their house. It is very real and very easy to understand. So it's top of mind for a lot of Americans, and this inflation story is the kind of inflation we have not seen for over 40 years. It's very notable, and it doesn't show any signs of lessening anytime soon. We'll talk a little bit about that in a couple of slides. Because of inflation, the Federal Reserve has changed course. The Federal Reserve had been what's called accommodative. That's a fancy term for easy money. In response to the pandemic, the Federal Reserve did any number of things. They have lots of tools at their disposal to provide lots of liquidity. In fact, historically large amounts of liquidity for the U.S. economy to help the U.S. get through the pandemic. Because of this red-hot inflation, the Federal Reserve has changed course, and they have signaled that they are going to raise interest rates. The expectation is for as many as 8 interest rate hikes in 2022. It'll probably last beyond 2022. We'll have to wait and see. The first example of this is the Federal Reserve raised interest rates in March for the first time in several years. They raised interest rates 1/4 point. And this is one of the primary tools that they will use, the Federal Reserve will use, to try and rein in inflation. But they do have a ways to go. It's going to be something that's going to last a little bit, in my opinion. But these three things have contributed to a tough start to the year, including the markets being down January and February, and most major indexes are down on the year. I'd also like to point out that sentiment in the U.S. has soured. There's lots of evidence that I could point to on this subject, but I'll give you a few. One is there's a very long-standing poll, right track, wrong track, and they ask Americans, do you think the country is on the right track or the wrong track? And I think the most recent polling shows that 68%, almost 7 in 10 Americans, believe that the economy is on the wrong track. That means 7 out of 10, or almost 7 out of 10, that means it's not just Republicans, not just Democrats. It really cuts across a wide swath of the American public. You also see this in polling. The American people, if you believe the polling, which can be a tricky thing, seem to be unhappy with the Biden administration. And I think that the Real Clear Politics average of polls has President Biden's job approval rating, I don't know, it might be 39, 41, 42, somewhere in that range. That's pretty low. Now, other presidents, including President Trump, had polling that low. And just because it's low now doesn't mean it cannot recover. But it seems like Americans have some angst about what is happening, not just in the country, but more recently what's happening abroad. And most importantly is Russia's invasion of the Ukraine. I, in speaking with clients at the beginning of the year, was of the opinion that Russia would not invade Ukraine. Got that one wrong. I'm not alone. Lots of people got that wrong. It's surprising to me because I looked at it and said that Ukraine had the 3rd largest standing army in Europe. Number 1 is Russia. Number 2 is France. And my thought was that the Ukrainian military had some bite to it. And for those reasons, I thought Russia wouldn't launch a all-out invasion. But they have. And Ukraine has put up pretty good military effort in fighting back against Russia. And so I guess that's good, because if you're like me, I believe most Americans, conventional wisdom is to root for the Ukrainians against the Russian aggression. I don't know if it's that clean, but I think it's good that the Ukrainians are fighting back. I root for them, but it's heartbreaking to see all of this devastation, the loss of life, destruction of communities and property, to see people fleeing. It's so upsetting, and it's hard for me, I don't know if you feel like I do, it's hard for me to even find who's winning in all of this. You know, the Russian troops don't seem to be making out too well. The Ukrainian people certainly don't. I don't know. It's just awful all around. It's very, like I said, upsetting. And so the market had a difficult time in the early going this year based on the inflation supply chain story. And then it was further upset by talk of the Russia invasion of Ukraine, and then really peaked when Russia, in fact, did invade Ukraine. So the market was down for the quarter. It was down notably in January, notably in February, mounted a bit of a comeback in March, which is good, but we still have a ways to go. In terms of history, I've shared this type of stuff with, I'm looking at the list of attendees, probably with most, if not all of you at one time or another, but these market downturns are uncomfortable, but they're not unfamiliar. I sent an email out a few weeks back that touched on this, how difficult these periods are, that they're no fun, but these declines are normal. Again, they're not unfamiliar. And these downturns often, history tells us, will give way to rebounds, very often strong rebounds. But how frequent are they? Let's look at some of the numbers. Since 1949, that's over a 70-plus year period, on average, the S&P 500 has had a pullback of 5% about 3 times a year. Pretty common. A correction, on average, has occurred about 1 time per year. That's defined, a correction's defined as a 10% decline or more. And a bear market happens once every 6 years. That's defined as a 20% drop or more. So the first quarter, based on that historical perspective, was a correction, a fairly mild one. We, as I said, have improved in March, and so far in the very early going in April, which is 2 trading days, we're up some more in the new quarter. So I wanted to share that historical perspective and also share this one, which I also believe was emailed to most, if not all of you, is when you think about war and how scary that can be, and it is, rightfully so, but if you look over history, it could help calm your nerves, because you can see that the market, when you look at history and conflicts that have occurred, these conflicts don't really interrupt the long-term positive performance of the markets. You do see some downturns, this is true, but it really doesn't change things much over the long term. And it also shows that there have been lots of instances over the last almost 100 years where you had armed conflicts of one sort or another. More recently, we could look to previous times where Russia was an aggressor. They took over Georgia some 10 years ago. Back in 2014, they took over the Crimea, which is a part of Ukraine. And in both those instances, the market had sell-offs. They were brief, and then the market rebounded quite well. I will grant you that this time around, this armed conflict is way more serious than what happened in Georgia or the Crimea, but it is a little bit of a nod to what might happen this time if we could get past this issue in the Ukraine and the shooting can stop. I'm going to talk a little bit more about that in a few slides. Next, I just want to talk about interest rates a little bit, because it's really incredible that we're still in an environment where the cost of safety is near 0%. This is from almost a month ago, where if you put money in the bank, you're still getting virtually 0%. So the average money market rate's around 0.07%. It's true that you could get some bank accounts, like an online bank account as an example, where you might be able to earn 0.4 or 0.5% higher than I'm showing you on the screen. But it's tough to earn any interest in the safety of the bank. Now, the Federal Reserve is going to raise interest rates, so interest rates will go up. But you guys have been around a little bit, just like I have. The banks will be slow to raise interest rates. They are much quicker when the Federal Reserve lowers interest rates in lowering the interest rate they pay you on your money saved in their institution. They will be much slower on the upside. And this is difficult for all of us because when you have inflation, when you have price hikes like we're seeing now, if you have money in the bank, it's safe. Yes, it will not decline in value. $100,000 will not be worth less than $100,000. But when the cost of goods and services that you would use that money for is going up by 8%, which was the inflation rate for 2021, your money is safe, not going down, but it is, this is important, it is losing buying power because that money will not be able to buy as much stuff as it used to. And so it puts people, and this has been going on for quite a while, it puts people in a little bit of a pickle because if you want safety, as defined as money in the bank, you get that safety at the price, the increasing price of losing buying power given the inflation we're currently dealing with. So hopefully I explained that and it makes sense. So I already mentioned that interest rates are going to rise in 2022, probably 8 times. It'll probably continue into 2023. But then again, a few years ago when the Federal Reserve raised interest rates several times, I thought that that would be a kickoff of a new era where interest rates would go up for several years and be a longer term trend. But that trend only lasted about 1.5 years, maybe close to 2 years, and then it stopped the end of 2018. And then with the pandemic, we saw interest rates go back to near zero as the Federal Reserve, as I said, tried to help the economy through the difficult pandemic period. I want to talk a little bit about inflation and why it's bad. One of the notable things about this inflationary season that we find ourselves in is that most Americans have not experienced this. You know, this is the type of inflation we haven't seen in over 40 years. You got to go back to the late 70s, early 1980s. That means that lots of business owners, entrepreneurs, corporate executives, consumers, heads of households, they haven't seen this, or they haven't seen it for a while. And so it's not that we're in uncharted territory, but we are in territory that lots and lots of people, including our policymakers and politicians, haven't seen in a very long time, if at all. And so when is inflation bad? When inflation is left unchecked, it could really escalate quickly. Picture like a snowball rolling down the mountain. It could pick up momentum. And I think you could make a case, and I think I buy into this mostly, is that the early stages of inflation that started probably in the spring to summer last year largely went unchecked. The Federal Reserve didn't do much to react to it. Again, their first interest rate hike didn't happen until this March, but inflation was notable and in the system for, I don't know, maybe not a year, but 8-9 months at the very least. The administration, the Biden administration, you know, they had not focused on inflation as they came into office and wanted to roll out lots of initiatives that they had campaigned on and that they believed in, but inflation wasn't a focal point. So I think it was left unchecked, and it could escalate quickly. The trouble with that is it can be challenging to rein it in once it kind of gets going. And one of the problems, one of the bad aspects of inflation is that you end up with higher prices outstripping wage growth. So use an example where somebody makes $50,000 and they get a 10% raise. In lots of instances, that would be a good raise, 10%. If, though, inflation is running higher than 10% in my example, granted they're making more money, but they might have lost ground in their standard of living if the cost of goods went up by more than 10%. So inflation's been running at 8%. At least that's what it was in 2021. This year it's been running more like 6-7%, depending on which numbers you look at. And it seems like we have had wage growth over the last stretch, but not enough to maintain standard of living. And that's a bad aspect of inflation, and that's what you want to ward off. This can be especially harmful for folks whose income is mostly fixed. The classic example of that is retirees who are on fixed income. They might collect Social Security and maybe a pension, maybe some investment income. It's difficult for them to raise their income to maintain their standard of living. One of the negative aspects of inflation is that you could kind of have a circling of the drain kind of effect, a damaging cycle, if you will, because you have rising prices, and then you have workers wanting higher wages to maintain their standard of living. So if they earn those higher wages, that increases the business costs. And then the business reacts to those increased business costs by increasing prices, which brings you back to the original part of the cycle. And so if you have this cycle, it could intensify and become problematic, that you have higher prices, so then there's higher wages, higher costs, business raises prices, and then you start the cycle all over again. The thing about inflation, tough inflation, is that it usually does not end well. It's difficult to put the genie back in the bottle. And the way that the Federal Reserve is going to fight this is to pull back on some of the liquidity, perhaps lots of the liquidity that was provided during the pandemic. And when they raise interest rates, they want to reduce liquidity, slow economic growth in an effort to rein in inflation. But that slows down the economy. And in some instances, it could slow down the economy such that it triggers a recession. We saw this in the early 1980s, where Federal Chairman Volcker went after rampant inflation aggressively, but part of the fight led to the casualty of the economy slipping into a recession. You're starting to see some early talk about the U.S. entering into a recession. I think it's premature. I do. I don't think there'll be a recession this year. Most economists are not forecasting a recession this year, but you are starting to see talk about it. For example, Deutsche Bank, I just saw this morning, Deutsche Bank is predicting a recession for the U.S. in the second half of 2023. Now listen, that's a long way away. I wouldn't, I don't know how much stock I would put into that forecast, but it is noteworthy that you're starting to see a little bit of talk about a recession in certain quarters. And if the Fed needs to raise interest rates a lot, and they need to do it quickly, and they have trouble getting inflation wrestled under control, the risk of a recession will continue to grow. Very low now, but will continue to grow. So mostly up to this point, I've talked about negative stuff, things to be worried about, things that have hurt the markets so far this year. But there are causes for optimism. Since the spring, summer of 2020, there has been, in my mind, a growth thesis. The idea took hold, even when the pandemic was kind of raging out of control. The thesis took hold that beyond the pandemic, the U.S. economy would experience strong economic growth, and that economic growth would last for a long time. And that has proven so far to be true. The U.S. economy has grown. It's been pretty strong growth. So Q3 was up 2.3% GDP. Q4 was 6.9%. That's from the BEA. And I think the expectation moving forward is for continued economic growth. This is driven by a couple of different factors. One is that liquidity I talked about. The Federal Reserve and the federal government under both President Trump and President Biden have put a lot of money into play. There's a lot of money sloshing around in the U.S. economy. Americans have a lot of money. Businesses have a lot of money. And the consumer is very energetic in their spending. This is another example that you see probably in your everyday life, just like you see the price hikes. You go to restaurants, they're usually packed. You travel, packed. Concerts, movies, live events. Consumers are out there. They have money after being cooped up during the pandemic, either because they had to or because they chose to, are anxious to get out there and spend. And that's doing wonders for the economy, and it's not showing any signs of letting up just yet. Despite that souring of sentiment I talked about a few slides ago, the consumer seems to be behaving like they don't have a care in the world. Now they do, but it hasn't affected their spending yet. And as long as the consumer maintains this spending, this optimism in what they're doing with their money, this economic growth story will continue, and that should help the country, the economy, and by extension, the markets. I think the conflict in Ukraine, there's cause for optimism because it has not spread. Again, we feel for the people of Ukraine, and candidly, I also have tremendous empathy for the Russian soldier on the ground. It just seems awful for everyone involved. But the optimism comes from the reality that the conflict has not spread. Other combatants have not entered into the fighting, and the conflict have not spread beyond Ukraine. This is good news. Again, a lot to be sad about, but it could be much worse if it spread. My opinion is that it will not spread, that the powers that be around the world are committed to keeping this a very regional conflict, and as bad as that is, that's not too bad in the whole scheme of things, and not so bad that the U.S. economy and most Western democracies, their economies can't go on their merry way and continue with economic growth and make progress coming out of the pandemic. So that gives me great cause for optimism. The last one I wanted to touch on is the rapid pace of change, is that we're living in an environment today where I don't think we're getting a lot of brand new technology that's changing our lives. But what we are seeing is the usage of existing technology expand. It's being leveraged. We're using it in new, innovative ways. We're using it more frequently. The adoption rate is increasing. And you see this, again, in your everyday life. This is notable. Zoom is a good example. There are many, many others. But history shows us that when you have periods of innovation and change, it creates terrific economic results. And that, by extension, should be helpful to the market, especially over the long term. Now, change can be difficult. But by and large, I think the dynamic part of the U.S. economy that we've seen over the last couple of years and we continue to see unfold is a wonderful aspect of what's to come for the economy and for the markets. Again, for me, that is a great area of optimism, and it is a testament to how great the U.S. economy is, how vital and dynamic it is. I want to switch gears a little bit and talk about diversification. I've been in the business for 30 years, and some things have stayed the same and some things have changed. One of the things that I've observed is diversification, which I believe in and still believe in. and will continue to believe in, is still important. But its benefits have changed a little bit over the last stretch, 10, 12 years, let's say. If you look on the right there, in an up market, you see that by being diversified, having money in different asset classes, and this is mostly restricted to, paper assets, stocks, bonds, U.S. stocks, foreign stocks, and so on, is you see in the up market, you get a little diversification. Not everything goes up together. There's some things that are negative. And the idea with diversification is you don't want everything you own to go up at the same time. Because if it went up at the same time, that means it could also go down at the same time. And diversification is meant to mitigate risk, to make the long-term performance a little smoother than it would be if you were not diversified. Conventional wisdom, which I believe in, diversification is beneficial. What we have seen, though, looking to the left of the chart, and I got this, by the way, from T. Rowe Price at a presentation I recently sat in on. The left shows you that when the market struggles, your diversification doesn't work so well anymore compared to what it did in the past. And at the beginning of this year is a good representation of that, because the stock market struggled with inflation, worries, supply chain difficulties, and then adding on to that the Russia-Ukraine story. The stock market sold off. At the same time, though, the bond market didn't do particularly well either. And historically, when stocks struggle, the expectation would be that the bonds would do well and offset the stocks at least a little bit. And we didn't really see that at the beginning of this year. We see both the stock market and the bond market mostly trading in sympathy. It doesn't mean that diversification doesn't work. It just means it's a more limited in terms of paper assets than it used to be. You can still get diversification in paper assets. You could also get it in other ways by owning real estate, collectibles, investing in a business. Most of my clients don't have all of their wealth in the stock and bond market. They often have wealth in other places, and that is appropriate. But I did want to share with you this because it makes our work a little more difficult when you are hoping your diversification helps you when things are getting tough, and that doesn't really work as well as it used to, at least right now. So as we begin to wrap up, let's talk about some key takeaways. Inflation is a key indicator. Watch this. It's very important. If there's one thing to watch outside of the risk of World War III, it's the inflation story. It is the key indicator for the U.S. economy and will have an impact on the markets, and it'll be with us a while, as I said earlier. Related to that, the Federal Reserve will reduce liquidity. They're going to raise interest rates. They're going to do other things like reduce their balance sheet, other tools that they have at their disposal. They're going to reduce liquidity to try and fight inflation. I'm confident that the country will continue to work to relieve the supply chain problems, but they're significant problems, and it's going to take a while, and that will feed into inflation, and we will continue to have troubles getting certain goods in a timely fashion. It'll probably get better, but I don't think we'll return to normal anytime soon. I think, as I said, the Ukrainian conflict will not spread, which is a good thing. Another key takeaway is that you're already seeing the fear of the Ukrainian conflict kind of waning. I don't want to be insensitive given the heartbreak that we see when we watch the news and read the news, but I think it's already a little bit of old news. I mean, the markets seem to have moved on. The great fear that we had in late February when the invasion first took place, it seems like our worst fears won't be realized, and people in the markets are starting to move on a little bit. Again, don't mean to be insensitive, but that's a key takeaway. And another key takeaway is what I've already said several times. History shows that a rebound may be ahead. I'm cautiously optimistic despite all the worrisome things: inflation, supply chain, political turmoil, the upcoming midterm elections, U.S. sentiment souring. I think that economic growth story is still intact. And if that's intact, I think there's a reasonably good chance that the market could work off what was lost at the beginning of this year and continue on its way this year, making this year a good one, maybe not a great one, for investors. Generally, for most, if not all of you, sticking with your plan is the best course, the best recipe for success. There might be instances where somebody ought to do something drastically different than they were doing before, but I don't think that that's the case for the vast majority of people that we work with, people we come across. If you stick with your plan, kind of hold your nose, go through this rough period, I think that you will probably be well served by sticking with your plan and letting things play out. So we're here to help. If you wanted to talk about your plan, perhaps changes to your plan, we would be happy to do so. But generally speaking, I think that is the best way to be successful. This is a slide I use all the time, including at the last presentation I gave in January. We want to be made aware when there's changes on your end. We want to communicate with you regularly. We want to have frequent discussions. Keep in mind, today was focused on the economy, but we are looking at changes in tax planning, estate planning, various investment-related issues for our clients. So please keep in touch with us. We will do the same with you. Note that we increase our business when we're introduced to other individuals. And I see in the long list of people that have attended, many of you have been very kind when it makes sense, making an introduction to somebody that may want a second opinion, may want a fresh perspective. And if there is anyone that you know that would be interested in that second opinion or fresh perspective, please let us know. As we wrap up, your health, your well-being is our highest priority. I appreciate the opportunity to work with all of you in meeting your financial needs. We're always planning for your success, and we're doing that planning together with you. So thank you so much. I appreciate you taking some time today to hear about my thoughts as we enter into the second quarter of 2022. I will not cover any questions. I'm just about at the 40-minute mark. But for those of you that did post questions, I'll reach out to you separately and cover the things that you brought up. Thanks again for listening. I hope you guys all have a great day, and happy Easter.